Good. Sorry again. If you can take your seat in order to start our session on emerging market that will be shared by Elina Ribakova, who is a senior fellow at the Peterson Institute for International Economics and also at Bruegel. Elina, thank you very much for joining. You will introduce also our speakers. We are still waiting for two speakers, Boris Vujcic, Governor of Central Bank of Croatia, and Jonathan Heath, Deputy Governor of Central Bank of Mexico, but I think we can kick off and start. And please, so let's close the door, and Elina, over to you. Thank you.
Thank you so much. So that gives us more questions to this lady and gentleman here until the others come. But I'm honored to be chair of the panel. I'm sure there'll be plenty of questions. And I will start with Piroska Mohacsi, who is professor at LSE. Of course, Rashad Cassim, Deputy Governor at the South African Reserve Bank. Thank you for coming here. And Deputy Governor Virág from the Hungarian Central Bank. Again, thank you for making yourselves available. And I like the title of this panel. I'd say emerging markets have performed almost as well, or in some ways outperformed developed markets. And many of people here I see from sort of experienced traders and strategists in emerging markets. If I would have told you a couple of years back just how much tightening the Fed would do, what would you tell me about emerging market effects, rates, and credit? You probably would not remember that asset class anymore, right? And so with all that, we have seen extraordinary outperformance in a way relative to expectations. So maybe with that, I'll start my first question to Piroska. Sort of where would you attribute that? Sort of how would you sort of set the stage, and then we'll talk to the two governors. Thank you.
Thank you very much, Elina. So I'm going to follow the rule of Milton Friedman, who was not only a great monetarist, but he was a great communicator. And what he said was to his students, wasn't one of them, can't claim, but comes from reliable sources. He told his students that if you want to make a point, make it really in the extreme so that people remember and internalize. So what I'm telling you is I'm pushing a little bit the points, but I think it is so because it's something really surprising what we have seen. I'm going to make 3 points. Number one is that the mature part of the emerging world, so I'm not talking about Argentina and the likes, but the mature part of the emerging market world has entered a whole new era with massive material improvement in its performance. That will be point number one. Point number two will be a question, what are the reasons, as Elina asked? And point number three, I will cite a few examples from a recent research that we've done actually with Elina and 2 other colleagues on central bank communication and central bank monetary policy frameworks in emerging markets, comparing those with the Fed and the ECB, and would like to highlight some of the areas of that research shortly. Of course, the paper is available, including actually from the National Bank of Hungary, where we recently published a focus piece on policy implications. So, what is the new, completely new emerging market world? What is this huge improvement? I will start with saying that the pandemic response was surprisingly good. Obviously, the pandemic was a massive shock for the whole global world, but I think overall emerging markets were able to mount anti-cyclical policies for pretty much the first time in their in recent modern economic history, and they have been able to do more with less. So there was quantitative easing by central banks. There was a fiscal policy response. There was a coordination of fiscal and monetary, but they, of course, were able to spend only less, but in a sense, they got more results from their intervention. There's a very nice IMF study that shows us, proves that point for emerging European market economies. So good pandemic response and the new nature of crisis response from emerging markets. After that, even the growth performance had been quite good. We heard some references today in earlier panels. So I'm not going into that, but that surprised a little bit even the IMF forecasters. Number 3 is that post-pandemic inflation pressures were pretty well managed by emerging markets. The inflation started to pick up maybe a little bit earlier, partly because of the composition of their measurement of the consumer price index or any other indices, which shows a higher weight of food and energy than in advanced countries. But overall, it was a global inflation in the end by first, second quarter of 2021, and emerging markets then reacted to this inflation flare much faster. And this is something that we look at our paper. And then even with the eventual tightening, where it came belatedly relative to them from the US and the Eurozone, ECB and the Fed, we have not seen capital outflows, been some capital outflows, but much reduced volatility, no sudden stop, which used to be the usual phenomenon. No major exchange rate pressures. Of course, there is exchange rate volatility, but we haven't seen the one that usually accompanied emerging market performance in this area at the time of the dollar, US monetary policy tightening. We haven't seen banking sector crisis. When was the last time when we had a major tightening and there were no real pressures? I'm not saying there are no pressures, but we haven't seen. In fact, we have seen distresses in the US and in Switzerland as opposed to emerging markets. So very good overall performance. Now, why is of course the question, and I think we can agree that domestic policy frameworks has really improved over the past decade or so, definitely since the global financial crisis. We are looking ourselves in our paper about looking at the monetary policy frameworks and communication, specifically in emerging markets, and we show this improvement, to which I will go a little bit further. There have been better coordination, a better use of fiscal policy mix during the pandemic and even after that, better use of macroprudential regulations. And importantly, there was an external factor in addition to this domestic improvement, and that was the availability, the much wider availability of foreign exchange currency swaps and repo operations for emerging markets during the pandemic, and hopefully that could be a kind of a feature in a globally integrated world where cross-border banking, cross-border capital flows are important. So currency swaps and repos are very important, and I'm hoping that Boris Vujcic, who is the governor of the National Bank of Croatia, will come, because he is one of the few governors who went on record to explain how exactly that worked, but maybe the other governors here can also share some experiences. Now, so overall, policy frameworks improved, and also the global financial safety net, if I can put it more broadly, with the much stronger and better established wider availability of the currency swaps in it strengthened. Now, my last point is that we particularly see this, and we analyze this in the mentioned work in the improvement of monetary frameworks, and a few highlights with which I will be closing. One is that emerging market central banks' transparency has improved, and the gap which used to exist in this regard between advanced country central banks, the ECB, the Bank of England, or the Fed, and emerging markets is actually closed in several countries, including Hungary, whose governor is here, and in the case of South Africa. Statement readability, since we're looking at communication, statement readability of central bankers and press statements have actually been in emerging markets better than by advanced country counterparts. The sentences are shorter, the words are easier to read, so you need a lower level of education level than in advanced countries to understand what the central bank wants to communicate to you, which is important. In this regard, though, there has been a big improvement, a deliberate improvement by both the ECB and the Fed in the context of their last strategic review, and this gap between the EMs, the positive gap in this case, and them has been eliminated. Emerging markets have improved also in forecasting inflation and communicating it better. They are not as good as advanced country counterparts in acting on what they communicate, what they will be doing if, say, inflation inflation is likely to go up or is going up. They communicate that there would be action, but not consistently delivering on that with commensurate, like interest rate or the balance sheet instruments. It could be that they are more, its a reason is that they are more subject to shocks, more frequent shocks may alter their environment more frequently, so it is good that they adjust. We also note that as a kind of a positive thing that emerging markets haven't relied on forward guidance as extensively and as literally and as committedly as advanced countries' central banks. And at the time of flaring up inflation post-pandemic, that really helped them. That really helped them to be more flexible and to adjust faster. Emerging markets also improved their frameworks and really adopted many of the principles of that the Fed and the ECB and others, Bank of England. They improved their framework based on those principles, but really paying attention to their special vulnerabilities. And that's a plus. So you adopt what's the best practice, but you modify it accordingly to your vulnerabilities. And that is paying more attention to supply side shocks. You don't debate that much whether it's temporary, inflation coming from temporary sources or permanent for a year or two. But you see that in your context, of course, generally weaker credibility, when there's a supply side shock and inflation is persistent, you act faster. They also pay more attention to exchange rate movements in their communications, and that is also pretty okay, given that they are still, some of them are still financial, have financial dollarization. So they're vulnerable in balance sheet sense to exchange rate volatility. So this type of adaptation to best practices to local circumstances has served well central banks in emerging markets. And indeed, as Elina mentioned, the real test of the pudding, as they say, was the post-pandemic big inflation flare and experience, where again, just to repeat, I mean, we have slides if you want to see. I think Mark said that he can distribute them, but to show that there was a faster response, communicated more timely, and then it allowed also the easing part of the cycle to be started earlier than in advanced countries. So maybe I stop here, but overall, a little bit, along the Friedmanian lines, pushing a little bit the envelope, but indeed this has been a great catch-up. The framework is there. How well it is utilized, of course, then up to the policymakers And we've seen that without going into details and country specifics, because of course countries differ here and there. But overall, emerging markets have done pretty well and perhaps outperformed in some sense the ECB and the Fed.
Thank you so much, Piroska. And we will then turn to Governor Cassim and then Virág to talk about the recent developments, and then maybe we'll turn into more discussion, Q&A, and eventually open it to the audience.
Okay, thank you. I'm just going to make a few brief comments. I mean, I guess the first thing is, I'm not a great fan of this notion that, some countries were more preemptive, did much better than others, as much as I'd like to pat myself on the back as an emerging market. I think, if someone rewrites the economic history of the pandemic and how central banks managed inflation, one of the important questions to ask is, what did every country, what kind of economy did they confront themselves with, and why did they have to act in the way they acted? So, for example, if you have, some people say, Brazil was preemptive, and it may well have been preemptive, say, relative to a country like South Africa. But the question is, Brazil went out of its target much quicker, at a much more rapid pace, and the indicators were very different. So I guess the real question is, given the data that every country confronted, did it act appropriately, or was it preemptive or not? And maybe it wasn't that the emerging markets did a great job, it was that the advanced countries maybe lagged a bit. But so I think that the two things we had that the advanced countries didn't have, we were not at the zero lower bound. In a country like South Africa, you can bring down your interest rates from 700 basis points to 350 basis points. That's pretty serious shock to the economy, a positive shock to the economy. And not being at the zero lower bound gave you a tool that many in the advanced countries didn't have. The second thing is that many emerging markets just don't take inflation expectations for granted. We don't have, we by and large have backward-looking expectations. These expectations move with current inflation data. So you're less complacent about what you see in expectations. And I think that was the second reason. But then you have few emerging markets who entered the COVID with high underlying potential growth. Then you had some who were very fragile, like South Africa, for idiosyncratic reasons. You had an energy problem, you had a logistics supply problem. So then you are in the situation where the economy is in a downturn, but distinguishing how much of that downturn is a supply effect and how much of it is a cyclical effect, made monetary policy far more difficult. Added to that, we had to deal with spillovers in a way that we never had to deal with before. I mean, remember, we come out from the great financial crisis where we dealt with search for yield, that capital inflows were coming into the economy, that appreciated your exchange rate. So the challenge was more that you were worried about the competitiveness of your economy. You offered fantastic yields compared to the advanced countries. Here you were dealing with it. I mean, at least the later part now of the pandemic, you were dealing with a totally different story. You were dealing, that search for yield was reversing diametrically onto the other side. If I take a country like South Africa, a well-known story is that at the peak of the financial crisis, we had 40% of non-residents owning our bonds, and it moved down to 20%, 25%. So you're dealing with that, but you also, the real trade-off that I think we all talk about, and I've talked about repeatedly, is you have a domestic economy that is weak, but on top of that, you're dealing with monetary policy spillovers from the emerging markets, and that made your challenge of determining monetary policy much more difficult. And I think you're right that one of the most important aspects of our reaction function was what's going on with the exchange rate. And I think that became quite disproportionate in our communication because exchange rate volatility became really serious. In this era today, I was speaking to someone from the Fed saying that the two most unpredictable elections this year is a big democracy like the US and a little country like South Africa. And in fact, you cannot build an election into a reaction function, but the immediate target of your reaction function is because agents are worried or investors are worried about your election outcome, the exchange rate is very volatile. And that is the single variable that is influencing. We had our last MPC meeting and people said, what's the upside risk you're talking about in your MPC statement when everything else seems to demonstrate that there's kind of, there's disinflationary pressures. And I guess for us, it was really this thing. The thing is that we're dealing with a highly volatile exchange rate. We're not meant to react to the exchange rate, but we do know that there's pass-through and there's non-linearities in pass-through. When the exchange rate magnitudes are a bit bigger, you get more worried. But let me just end there, and I'm happy to open up conversation.
Thank you so much. Governor Virág?
So good afternoon. First of all, thank you very much for the invitation to the panel. I have to say that when I firstly read your paper, Piroska, my first thought was, okay, I'm satisfied with that, because I saw the improvement in the case of emerging market central banks, especially in case of Hungary. So one of my first reactions was that, okay, I can sit back, we have to continue the improving trend, and after we can say it's okay. My second thought was very similar to that one Mr. Cassim mentioned. So I think behind these results, behind the reactions we saw in the emerging markets, there are some very, very unique elements building to that environment we had in the last 3 or 4 years. So I strongly believe that the emerging market economics had a more stronger cyclical position before the COVID-19 crisis on the one hand. On the other hand, those supply side shocks we saw in the last couple of years in the field of energy, in the field of like the geopolitical risk premium shocks, especially in the Central Eastern Europe, generated larger tensions in our markets. So that's why I think it was a need to react in a preemptive or in proactive way in the emerging markets, to react in a proper way for this type of very unique shocks we saw in the last couple of years. We did that. I think it was a need. I also agree with Mr. Cassim, who mentioned that the emerging market central bankers are talking a lot about the FX, about the exchange rate. I think it's also a need, because we have to know that the whole environment we are operating nowadays has changed relative to that situation we had in the last decade. So in that decade, in the last decade, we saw in case of the emerging markets, a very low FX pass-through towards the inflation. So based on the currently available analysis, the FX pass-through toward the inflation increased in the last couple of years. So that's why we have to put more emphasis on the FX market, because otherwise we will not be able to maintain the low inflation environment, especially in a case where the structure of inflation has changed also a lot. I think it's worth to look at the numbers in many countries, not only in the emerging markets, but also in the developed world. So nowadays, it seems to me that the higher services inflation is not only a 1 or 2 year phenomenon. It can be a structural issue, mainly linked to the labor market situation we have nowadays globally. So, of course, in the last 3 years, we lived in a multiple crisis environment, but I think one of the most important structural changes we saw in the labor markets everywhere. So the demographic trends started to play against the labor market. It generates higher nominal wage growth in our economies, and at the end of the day, it will generate higher services inflation in the services sector, where the labor intensity is higher than in other parts of the economy. So what does it mean at the end of the day from a monetary policy point of view? So if we will face higher inflation pressure from the services sector, in an open economy like the CE countries, we have to put more focus on the imported inflation, because otherwise we will not be able to drive back the inflation again to a low territory. So that's why I think nowadays we have to put more focus on the FX market developments, because again, the role of the imported inflation in our life increased, the FX pass-through also increased, and the final conclusion from the Hungarian story in the last 2 or 3 years. So I think the risk of dollarization, the risk of euroization in a very volatile and uncertain environment is higher. So I think that's the other aspect where we have to put more focus on the FX market developments, because otherwise our economies will go through a dollarization or euroization if we are not able to control the FX market developments. So that's my comment in a nutshell.
Thank you so much, and thank you, Governor Vujcic, for joining us. And I'm going to ask you, do you think ECB is going to cut 3 times this year, and will it do it in June?
So you like to ask the questions to which you will not get the answer.
No, I'm joking, of course. No, it's wonderful. I'm just checking if everybody's awake here. So you've heard the governors. You didn't hear Piroska, but you understand the context. I think I want to ask you actually about the support from the ECB and the Fed for the emerging markets. With the swap lines, sort of the repair to the global financial architecture that has happened somewhat, right? It's different than the taper tantrum of 2008. Do you think it was important? Is it all the work of emerging markets that we did better, or is it also some of the support that came from the Fed and the ECB?
I think it's both. I think there was a better reaction of the emerging markets than in the previous crisis, in a sense that they've learned from the previous crisis. They acted early. They acted earlier than the Fed and the ECB started to hike the rates, and then now they are also earlier to cut the rates, as you know. But that has definitely helped them. Also, the currency mismatches were reduced compared to the previous crisis. That also helped, not fully, of course, but to some extent. And then the fiscal space that really differs from country to country. Some had more fiscal space, some had less fiscal space. That has also determined how they could have responded to the crisis. But definitely the response was probably the best that you can remember ever on side of the emerging markets, central banks, but also to a large extent, I would say, ministries of finance. And then the second component is the Fed and ECB lines, swap and repo lines. Fed used to do more of it before, and they did it also more this time around in terms of the total amount and the number of lines. But the ECB also did more this time than before. For example, Hungary got a 4 billion repo line. We got the swap line because we were already basically in the ERM, which makes that important difference. Of course, it's better to have a swap than a repo. Because, in our case, that was a real game changer. There was a huge pressure in March of 2020 when the whole thing started. We had to sell off 2.7 billion euros of international reserves, which were at that time around 16 billion, just to give you an impression, within 4 to 5 weeks. So if you do any projection, it didn't look very well if you would have to continue. And of course, there were people shortening the domestic currency, but it was less of a, I would say, at that moment, external factor. It was more internal because there was so much uncertainty that the main driver of the crisis were redemptions from the investment funds. Some people thought it's the end of the world, maybe, so they started to withdraw money from the funds. So the funds sell off government bonds. So you had a sell-off of government bonds, redemption from the funds, and people who took money out went into the foreign currency, into the safe haven, into the euro or a dollar, but mostly in euro in our case. So you had a combination of everything coming together, where it's very difficult, of course, for the central bank then to act and intervene, because on one hand, if you provide the liquidity to support the bond market, you're creating an additional fuel to the traditional dilemma that we had. And then the moment we got the swap line from the ECB, everything stopped. So that the moment of the announcement of the swap line stopped any currency pressures, and everything calmed down, which also then enabled us to start with the QE, because otherwise it would be much more difficult to do the QE also. And then we could do the QE, which completely then stabilized everything, from currency to the bond markets. It all happened very fast. It all happened within 4 weeks of a drama, and then 2 weeks until everything calmed down completely. And basically then we bought back more than 3 billion euros of foreign exchange, which started to flow back immediately. So it was within the 2 months that the whole thing happened. But of course, the fact that you get a swap line at that moment was a real game changer.
Thank you so much. We talked a little bit about the fiscal monetary policy coordination, and maybe if I could start with you. How do you think about it now going forward, Governor Cassim? You mentioned about the elections, the funding for the fiscal. So how does that affect your thinking about the near term for inflation and for your path?
Well, the thing with South Africa is that we have a serious fiscal premium, a risk premium from the fiscal policy. You have an economy whose growth last year was 0.6%, but whose fiscal deficit, is around 7%, and it's been very hard to consolidate the fiscus when your economy is growing at the rate it is growing. Now, the impact on fiscal, I think, is a bit on the South African economy is a bit more complex. It is not. I like using the analogy of the academic Eric Leeper, who talks about hydraulics. So we're not. The fiscal expansion hasn't per se contributed to inflation. In other words, there's no real demand inflation in the economy. What has been more tricky about South Africa is how the continued issuance of debt is contributing through financial linkages and so on to making monetary policy difficult. So one of the real issues that has been a very interesting discussion in our minds is, why is it that if you take a 10-year local currency bond in South Africa, you would pay, the investors expect anywhere between 11% return. But if you take some equivalent Latin American countries with similar inflation profile, similar fiscal challenges, those yields are a bit lower. And it is a puzzle. It's a puzzle. What is so unique about our risk? And I guess the question is, what does monetary policy do when you're not, should monetary policy compensate for a higher fiscal deficit or growing public debt? And that compensation is not to manage demand. It's not to kind of say fiscal is leading to demand side inflation. Sometimes that compensation is is really the exchange rate, and it may be, it may be a very crude tool, but those are one of the areas. The second issue is this kind of vicious circle. So you've got fiscal expansion, you've got the self-reinforcing need to issue more debt, and if you are issuing at least more long-duration debt, that in itself contributes to a steeper yield curve. So, but overall, I think that the monetary policy has been less of a challenge because you don't have a overheated economy. All you have to do is manage. Think about what exactly your challenges are when a large part of your yield curve is a kind of a fiscal premium.
Thank you so much. And maybe the same question to you, because also there are expectations about European funds spending. Fiscal, sometimes some people would say compensate for what you do on the monetary side.
Yeah, I think in many cases in the history, to find a proper policy mix between the monetary and fiscal side will be the key looking ahead. And I would like to touch 2 points in that issue, one related to the short run and the other one to the mid to longer run. So in the short run, I think one of the key lessons from the last couple of years, both on the side of monetary policy and on the side of fiscal measures, is that it is much easier to inject liquidity, to inject loose monetary conditions, to inject loose fiscal conditions into our economy than to withdraw these measures. So I think that's the conclusion from the last couple of years. So the policymakers made a pretty good job in injecting a lot of liquidity during 2020, 2021. But nowadays we can realize it's pretty hard to change the direction of the boat and to withdraw this money from the system, to withdraw this liquidity from the system. In Hungary, that's why we use an approach where we don't want to withdraw the liquidity from the system, but we started to manage the sterilization direction. So that's why we increased the reserve requirements from 1% to 10% in case of the commercial banks to sterilize the money in longer term. But generally, I think it's an issue for the central banks. Looking at the case of fiscal policy, so it's pretty clear that at the end of the day, if you run with higher deficit, it doesn't depend on you are an emerging market or a developed country. At the end of the day, you have to pay for it. And I think nowadays the situation is changing very, very rapidly on that field. So it's worth to look at the case of the United States, where I think there is a good chance that the yields can remain about 4% in the coming years, and I think the implication for the emerging markets can be very painful on the side of financing costs. So that's why in the short run, I think the key task for these policymakers and the proper policy mix is the following. So the central bankers have to remain in a tight monetary policy stance, because of course we step ahead a lot in the field of disinflation, but we are still not in the end of the road, so we cannot sit back. While on the field of fiscal policy, we have to continue a gradual decline in the fiscal deficits toward a more sustainable territory, because otherwise the interest payment on our debt can be very costly looking ahead, and it can be very dangerous for the countries, because at the end of the road of this type of stories can be a debt crisis, or all of the countries will move into the direction of Japan, bringing back the big QE programs. So that's why I think we need a very well-designed and very disciplined policy mix. And the third factor is linked to the supply side of the economy, especially in Europe. So we have to deal more with the productivity growth in our economy. So I think we have to speed up the competitiveness reforms. We have to speed up the technological revolution, the digital transition. We need stronger productivity growth in our economies, because otherwise, in a low growth environment, we are not able to control the debt ratio. So that's the other comment.
Thank you so much. Can I ask a follow-up question? You flagged a lot of risks on inflation, but also inflation has come down in Hungary faster than many market participants expected here. What do you think are the driving factors, are these lasting driving factors?
I think it's also true for the inflation. We have to find a proper combination of the policy mix. Of course, one of the key drivers is the tight monetary policy conditions. So the central bank have to lead the battle against the high inflation, because we are the institution who is able to react immediately, who is able to encode inflation expectations. But I think in the last couple of years, the nature of the shock was very, very complex. So we faced not only the traditional demand type shocks in our economies, we imported a lot of supply side issues in our countries, partially coming from the energy markets and partially coming from the competition situation in our countries. So in Hungary, we saw that in many sub-markets, the monopole firms had the opportunity to increase the margins in their pricing. So that's why it was a very important step in the last year in Hungary that the competition authority made very, very important steps in the field of competition. They opened new platforms to incentivize the competition between the players, to increase the transparency of the pricing, and they send very clear messages from the government side to, to remain better controlled on the side of the margins. So I think we have to know that we are living in a very unique environment. We are facing not only demand type shocks. I think the central bankers have more tools to control the demand type shocks and to smooth the cyclical movements of the economy. But nowadays we have to prepare for supply side shocks. So I think that's why the proper combination of the central bankers and the regulators are needed looking ahead.
Thank you so much. We have about 10, a little bit over minutes if we would like to open it to the audience, maybe ask some questions. Well, there are arms going up.
Thank you for the comments. I've heard you guys bring up the idea that fiscal costs are rising, interest costs are rising, and this is happening in a still subdued growth environment. How do you think about sort of the risks around this? Essentially, what you need in terms of rates to boost growth is that you need lower rates, but the market is basically telling you that you need higher rates, which may be unsustainable fiscally. So how do you thread the needle here? This, to all of the participants from central banks. Curious in each one of your responses.
Let me kick off. I mean, it's very unfortunate if you are in a position where you need growth and your interest rates are still high. I mean, this is what monetary policy sadly often has to do. That sometimes you even have to generate a recession to get inflation down for longer term growth. So I think that it sounds like a very simplistic answer, is that at the end of the day we all rely sometimes mechanically, but in most cases not, on some tailor intuition where I think that if you know that your output gap is negative, then it does moderate your need to either loosen or tighten depending on circumstances. So I think it's it's a familiar story that there are two sides to the way you think about inflation. There's what I call the output gap side, and that is that the economy is not doing well. There's disinflationary effects from low economic growth, but that has to be offset against all the supply side shocks, and these supply side shocks may be oil, they may be high interest rates, and they may be exchange rate. But I do believe that most of our interest rates have endogenous to them the state of the economy. It may well be that in our case, if we had a big positive output gap, we're still not at our midpoint. Maybe the nominal rate would have been much higher than what it is currently. So that's how I would think about it.
Thank you.
Just a quick reaction. So I think first of all we have to deliver our own homeworks on the expenditure side of the budget. So what does it mean? So we are talking about we have to spend more on defense. We have to spend more on infrastructure. We have to spend more on green transition. We have to spend more on the healthcare system and so on and so on. But we have to always raise the question in which area we have to spend less. And I think there are some low-hanging fruits in all of the countries. My other comments is linked to the revenue side. So again, I think one of the key game changer factor nowadays is the demographic trends everywhere globally. And I strongly believe that the governments will not able to generate the same amount of revenue in an environment where the demographic trends are worsening. So that's why I think in the near term there is a need for a tax reform everywhere to stabilize the fiscal conditions. So of course we have to increase the role of the green taxation, and of course we have to find other type of new taxes to fill the gap between the revenue side and the expenditures.
There is a question.
And in our case, it's a bit specific because we entered into the Eurozone now.
Please.
But we still do have a fiscal policy and the public debt. But the public debt in Croatia has actually came down from 86% in 2020 to 57% projected this year. So by 30 percentage points within basically 4 years, which tells you it can be done. Well, but it requires certain circumstances. One is that you have a rebound, of course, from the 2020 high growth, and we had a high growth 21, 22, 23. We're going to have a relatively high growth this year, and on top of that, since we entered into the Eurozone, the risk premium came down, so the interest rates came down. So you have everything blowing the right way at the moment. So the continuation of the public debt to GDP reduction will be also in 25, 26. So in the end, we'll probably end up until the end of our projection horizon from having a public debt of 86% to 50, very, very quickly. And that's something that, of course, is important then for the government, not to cherish that too much and decide that there is money to spend, but to keep on that track. And I think that's what most likely will happen, because we had prior to the 2020, we had 5-6 years of a policy of a balanced budget. And this is a kind of idea to have a balanced budget. This is kind of got ingrained now in thinking in Croatia of how you run the fiscal policy.
Thank you for your comments. My question is pertaining to recognizing how much recognition there is that the U.S. is at a different place. Our fiscal deficit, tendency to deglobalization. So every time there is a U.S. CPI print out, you're going to then freak out and might look at you guys and say, what are you going to do? Or are we going to recognize that US is going to actually crowd out funding for emerging markets? And this would require substantially higher R-star and weaker currencies, in terms of EM policy. So my question is, are you viewing US as structurally in a different zone, requiring you to adjust your policy accordingly?
So look at, so obviously the decision made by the US policymakers is one of the key indicators in the global financial market. So of course we have to closely look at the situation in the US market. So now I see a chance for some divergence between the Fed and the ECB policy looking ahead. So of course, in our region, in the Central Eastern European region, now the big question how this divergence in the interest rate policy can have an impact on our markets. And I think it was to differentiate between the short-run impacts and the mid-term impacts. I think in the short run, taking into account the very volatile environment globally and a very sensitive risk appetite globally, I think in the emerging markets, the impact is coming from the Fed side can be more dominant because that's the lesson from the last couple of years. If the dollar appreciates against the euro, it can generate volatility in the emerging markets. So that's why I'm saying we need a very cautious and patient monetary policy decisions in this stage. We have to provide still the proper level of positive real interest rate environment in our economies, at the proper level of carry to stabilize our markets. In midterm, I can imagine as the ECB is going ahead in their own rate cutting campaign, I think that the European investors can be more interested towards the Central Eastern European markets, and it can give an opportunity for the regional central bankers to not to sit back, but to have a more room for maneuver in their decisions. But not in the short run. So again, in the short run, I think the Fed effect is more important.
Maybe last question in the back. Thank you.
Yeah, as Governor John Connolly used to say in the weak dollar days, it's our currency and our problem. What if the strong dollar of today, which seems a little out of line, comes off because they don't control inflation in this country? What then would happen to emerging market currencies?
Well, I would say that there is obviously a strong dollar, and we have an eminent expert here, Yoon, who's written a lot about this, and that is that one thing for sure, that a strong dollar has an important consequence, and that is that if you are relying on financial conditions as your main transmitter, that it has the potential to contract your economy. So I think that is one of the issues. So you've got a strong dollar that has this impact of increasing funding costs. Everyone's dependent on dollar, and I think that that's the case. Now there is this question of many of us say, well, if you look at our dollar local currency exchange rate, and you look at your real effective exchange rate, trade weighted real effective exchange rate, the numbers are quite different. If I look at our currency, the local rand did not depreciate as much against the pound as it did against the dollar. But I guess that is given the prominent role of the dollar and dollar invoicing and so on. Whether the strong dollar would, that's the financial channel, whether the strong dollar has an impact on the trade channel that, that may offset some of the risks that come from the financial channel, that could be an interesting issue, but it needs empirical work. Yeah.
So I don't want to overreact the question. So for me, the other lesson from the last couple of years was that the situation in the narratives has changed in every 6 months. So I remember at the beginning of last year, we talked about higher for longer story. At the end of the last year, we talked about the Fed could cut the base rate by 6 or 7 times in this year. Nowadays, we are talking about the Fed may cut the base rate one or 2 times in this year. So one of the key conclusions from the last years is that the main narratives are changing very rapidly. So that's the volatility is the key nature of the current environment. So I can imagine in the short term that the dollar will strengthen further, but of course it will generate a reaction on the ECB side because the ECB would like to avoid the non-intended inflation risk in midterm. So that's why I don't want to overreact the current assessment that we are moving in a path of further depreciation in case of the dollar. So we will see. At the end of the day, I think the supply factors will be the key success variables in our lives. So the task is still the same. We have to speed up the supply side reforms in our economies.
Thank you so much. With that, sorry, Boris.
No, if it's not the emerging market anymore, country issue, but from, I would say from the, I've been asked this question 3 times today already, so let me know, because everybody's now looking at the possible divergence between the ECB and, if the rates stay where they are now with Fed and we start with a cutting cycle. So if the spread widens, because it's there already, it has been there for, it's like people forget that their rates are already significantly higher than ours. So let's say whether the 25 or 50 basis points does so much difference, I'm not sure. So far, markets, if you look at the FX markets, they were very calm. Having known all that I've been asked today. But conceptually, the issue is that you have a pass-through effect, which we don't know what it is, because all the papers that we have, all the measures that we have pertain to the period when there was very low inflation, nothing going on. So most probably, as you said before, now the pass-through is somewhat higher. Whether it's much higher or not, we don't know. And then on the other hand, you have this general equilibrium impact of the Fed setting the rates and keeping the financial conditions tighter overall in the international financial markets, which takes off a bit of a global component of the inflation, which also affects us. Now, empirically, which one prevails? Well, because you will be still pricing off the US yield curve with the arbitrage tightens the conditions. Which one prevails? We don't have such a good empirical evidence, so we'll have to find out. And that's why we have to really be data dependent and go, meeting by meeting and see what is going on. First, in terms of whether there will be much of a divergence. That's the first question. And then what it brings to the FX market and how that is transmitted. And there are many ifs that will, and we will discover what happens along the way in next months.
Thank you so much. We'll let Professor Shin respond to this and other questions in the fireside chat now with Maximiliano, who is coming here. Thank you for staying with us, and thank you, governors and Piroska, Professor Piroska, for being with us today. Thank you.